Hey guys, it's about 4 o'clock, so I'm about to kick off with everything. James unfortunately can't join us today. He's just got tied up in a few meetings, so you guys have myself. If you have joined us before for a eBury webinar, you'd know that I keep these short and sweet and to the point. I don't really ramble on about what's happening in markets. We try and keep it more to what's relevant for everyone that's attending today. So just to go through a summary of what we will be talking about today, it's mainly going to be around Russia's invasion of Ukraine. It's been the headline at the moment, what's going on over there. We know it has escalated over the last few weeks. Unfortunately, we don't see an end in sight. There has been comments around peace talks and, some type of ceasefire, but unfortunately, again, we haven't really seen it. So what we're going to be going to talk about is, how markets have reacted, what it means from a macroeconomic sense. A lot of you guys here would be hearing about inflation pressures. Why are we seeing inflation from a war? What does it mean for supply chains? What does it mean for, anyone that's importing or exporting goods? Because unfortunately, with what's happening over there, it's got some long-term impacts or chain flow impacts into how we operate, even all the way here in Australia. And we'll also go through what central banks are talking about and how they view it. And we'll go through 3 central banks that's going to be relevant for everyone here today. So the European Central Bank, the Federal Reserve, who've been quite vocal this week, and our very own RBA. I'm pretty sure the webinar is set up for questions at the end, so please hold them back. I think there's going to be a little question box that you guys can go on to ask them. If not, you're going to have our details to reach out to. I know a lot of the people in today are existing clients, so hello. I know some of you guys speak to me on a daily basis, so hopefully you enjoy it. So let's kick off with what's happening. So what does it mean with the Ukraine war? A term that I use a lot to describe events like this, it's a risk-off event. So anything that's geopolitically impacting the world economy sees risk-off moves. Typically, when it's a risk-off move, we see assets, risk-based assets become more attractive. So like your US dollars, your Swiss francs, your yen, and we typically see the Australian dollar sell off. However, since this risk that we're seeing is isolated in Europe and specifically in Ukraine, we've seen non-traditional risk moves. So typically where we see the AUD sell off, we've seen the Aussie somewhat maintain its level. And due to the sanctions in Russia, we're seeing commodity prices, set higher. Now, keep that in mind for future slides about sanctions and commodity prices. And particularly what we're going to be talking about is oil prices, oil and coal, actually. And since there's sanctions on them, that's what's really driving the Aussie higher. So we'll talk about that. And as well, we're going to talk about how the set-off in commodity prices, them going higher, and how that feeds into inflation. So at a base level, inflation is, the change of price of goods. And since oil, where I think 30% of Europe's oil comes from Russia, it is used everywhere. So from flying to transport to, day-to-day living, I think oil at the pump at the moment is around $2.50. It contributes to everything. So unfortunately, a rise in oil prices is going to impact everything. And then at the end, we'll have to have a look at what central banks do with it. What's quite funny is a rise of interest rates is usually what central banks do. But if a rise of interest rates happens, that doesn't really reduce the price of oil, does it? It just makes things more expensive. It makes servicing debt more expensive as well. So let's have a look at it. So inflation. With what's happening in Ukraine, unfortunately, a lot of fundamental market moves or economic moves have been ignored. Like I said earlier, oil has contributed to inflation pressures, which have already existed from the last 2 years, mainly from COVID. Supply chains being disrupted, not enough container ships around. And now in 2022, that's been further fueled, pun not intended, by oil prices going up. Unfortunately, right now, we see that energy prices will continue to rise until sanctions stop from Russia or to Russia, or if we've seen an increase in supply. So like I said, the biggest dilemma at the moment from a central banking perspective is raising rates, yes, can control demand, but it's not going to do anything with supply chain issues. So if you guys have a look there, inflation in the three biggest economies in the world are now up to quite significant levels. So everyone is aware, typically a central bank's inflation range is about 2 to 3%. They're comfortable with that. It means that we're growing at a sustainable rate. Typically it's in line with what wage growth looks like. Unfortunately now, or from last year, inflation's now at 6 to 8% in most countries. In Australia, it's trading at about 3.5%, so we're not really impacted by the rest of the world yet. But if you have a look at, say, US inflation at the moment, that's at 8% at the moment. So that's really impacting them, and that's why we're seeing the Fed be a bit more aggressive. More on that later. So looking at markets. So like I said, typically we see risk-off moves in this fashion. It's gonna have to go back 1 second. So typically we see risk-off moves in the market. The Australian dollar did not experience a risk-off move. Risk-off moves really see a sell-off in equities. We saw Russian equities, I think, fall off nearly 0.5%. We also saw the ruble fall a fair bit. And for a brief period in March, we saw the ASX fall below 7,000. This week's been very good at the ASX though. I think we're about 7.2, 7.3 at the moment. We also saw yield curves go down a little bit lower because people expected that the central banks won't be changing interest rates anytime soon. More on that later. And we saw really sharp prices in commodity. So we saw oil go to about $1.30. We see coal at about $400 a ton. And the rise of those commodities have helped the Aussie over the last, say, 4 weeks. So just reiterating what we said earlier, the biggest moves in currency was the ruble. So that had a big sell-off, obviously because a lot of people holding rubles couldn't use that for the purchase of goods with the sanctions being put in that country. And as well, any surrounding European countries. So from the euro to the Polish zloty, the SEK, the DKK, the Hungarian franc, any country in the Eurozone, whether that's the euro or not, did get impacted just due to the proximity. We also saw impacts against the pound. If anyone here is trading against the pound, you'd notice that the Aussie pound exchange rate's now around 1.77. That's close to the highest levels it's seen over the last 12 months. So really good times if you are importing from there. However, you may have issues from supply chains to ships being stopped and just delays that we've been seeing over the last 2 years. For anyone dealing in CNY, you guys would have noticed that the Aussie has performed relatively well against the CNY. However, the CNY is performing or showing risk on trades. So against the US dollar, it's actually held its own, where the US dollar is actually rallied against most other currencies. Anyone trading in the NZD as well would have noticed that we saw some stability with those currencies. So to explain that, that's really just a geographical positioning. So we're so far away, and commodities. Aussie dependent on iron ore and commodities across the globe. NZD really related to dairy prices, so big demand for that. And CAD's an oil currency, so any increase in oil sees an increase in the value of the Canadian dollar. However, what we're seeing at the moment is central banks have started to, pay a lesser eye on what's happening. As of this week, we saw central banks start talking about inflation rather than the invasion of Ukraine. So we're seeing global equities recover slightly. We've seen the USD not rally as fast. For anyone trading currency today, you guys would have noticed that the Aussie US is around 74.5 at the moment. It's close to about a 4-month high. The last time we saw these levels was in November. And as well, we've seen a little bit of a recovery from those Central European currencies. So those currencies I said on the last slide have picked up from when the invasion first happened. Other interesting things to see as well is there's a little bit more appetite against the ruble. In my view, I feel like this is just a little buy the dip. There's a few traders out there that have the assumption that we may see a recovery, or we may see a ceasefire, or we might see peace talks rather sooner rather than later. I think for peace talks to actually happen, from recent headlines, they need to give up Crimea and that Donetsk area over to the eastern side of Ukraine. So I still think we're still far off from peace talks, but some traders view differently. The currency that's probably most impacted to us here in Aussie is the euro. I don't know how many euro buyers are here at the moment, but you guys would have noticed that the euro hit a high of about 68.5 cents. It's actually fallen to its lowest level against the US dollar since May 2020. So around when COVID first started. And that's really just due to the proximity and how close the Eurozone is to what's happening, and as well the dependency Europe has on Russia. Unfortunately, right now, there's a big shortage of oil and gas over there, as Russia supplies close to 45% of that to the Eurozone. As early as today, Germany's talking about rationing oil and gas to try and support or try and limit inflationary pressures. We really need to see some type of control and spend. So unfortunately, right now, our friends in Europe, they are struggling a little bit more than the rest of the world. Hopefully summer and rationing might help them moving forward. And again, probably a bit more detail on this. Why is commodities slightly stronger, or why have commodities rallied so hard? It's because of how much commodities come out of Russia. So Brent crude oil before this all happened was sub 100. I think it was around $80 to $90 a barrel. Now it's at 130. And it's very difficult to trace what that's going to do over the next coming weeks. We've hit highs of about 140, 150 to around 120 at the moment as headlines start coming out. What's really interesting as well, though, you could still buy Russian oil at about $80 a barrel. However, I think you're going to be frowned upon if you're going to be doing that. Certain wheat as well, certain commodities have also rallied quite a fair bit. Wheat is slightly higher. Commodities, coal, which hasn't really been spoken about, has jumped nearly, I think, 100% from about $200 a ton to about $400 a ton. So that's something significant. We expect it to drop off as summer comes along in Europe. So just showing what's happened in terms of commodity currencies. Aussie's doing well, and a lot of exotic currencies are doing well. So what we see there is, as much as it's risk-off tones, it's isolated risk-off tones. So just remember, we typically see the Australian dollar sell off. Unfortunately, that's only staying in Europe. So we're seeing the euro sell off now, so that's showing risk-off moods, and we're seeing the Australian dollar rally. This just gives you guys a look on what's happening across the globe. Your South American currencies are actually doing really well. So macroeconomic implications. So let's have a look at sanctions. The first thing that the West did was remove Russian banks from the SWIFT network. For most clients here, you guys would be aware SWIFT is how international payments are made. When that was announced, we saw a big sell-off in the ruble, and we saw a lot of companies cease operations in Russia. What's really interesting, though, is a lot of the Russian FX reserves are in foreign currency. Over half of it's in G3 currencies, and about 3% of it is in CNY. So basically, they can't use their FX reserves. What the West is trying to do is, instead of using force to come to an agreement, they're using economic sanctions. Basically, you can't really trade with Russia at the moment, unfortunately, just because of what's happening. Unfortunately, with what's happening globally, we're seeing the ruble do sell off. However, due to some type of FX reserves from Russia, we're not seeing it completely worthless. So the ruble is still holding some ground, and there's still some traders, as we mentioned earlier, that have the view that this could end shorter than we think, which should see a rally back in the ruble. If the war does end earlier, what will happen is oil prices go back down, commodities do start to taper off, and we may see that Australian dollar correct itself from the high levels that we're seeing at the moment. Going back to what we also spoke about, the sanctions on oil and Russian trade is always going to support inflation or fuels inflation. Until that's lifted, we're going to see high levels of inflation. So the correlations that you guys want to take notice at the moment is long war means high inflation, high import costs, interest rates going higher, and probably the Australian dollar maintaining its level. If we see a ceasefire, or if we see that peace talks do happen, we may see the Aussie come off a bit from these current levels. So what's going to happen over there, though? In Russia, I feel like it's already stuck. We might see strong recessions there. You can see in headlines that the public are not supportive of this war because it's actually hitting their back pocket. The value of what they have in the bank's worth 50% less than when the war started. And as well, any Western operations over in Russia could cease for a while or might not continue moving forward. They might have something like a North Korea situation over there. If things don't get better and we see commodities up higher, we see interest rates higher, what will happen is a long war will impact into a stagflation moment. What that means is periods of high unemployment, high interest rates, high inflation, and really just a slowdown of global growth. So we don't want to see a long war because it's going to start impacting everyone else. And just reiterating what we spoke about earlier, how this war is inflationary and we don't want to see it go longer. So moving forward, we're going to talk about what central banks are talking about right now. So we'll start off with the European central banks, because they're probably closest to it. Then we'll talk about the Fed, because they spoke this week. And then we're going to have 1 or 2 points from the RBA, since they're relatively quiet. So the ECB, let's have a look at it. They are looking on recalibrating what their view is on the market at the moment. Before the war started, they were looking on 100% rate hike this year. The Ukraine-Russian crisis has kind of slowed down their views. We see a rate hike from them by September. So if you have a look here, inflation is an issue with them, and that's the reason why interest rates are on the way up. Despite what's happening there and an economic slowdown in Europe, the ECB, so the central bank, sees that the main concern is slowing down inflation. And this is going to be the trend that you guys are going to start seeing over the next couple of months. Unfortunately, as inflation is great because we see things grow and, people could be making more money or businesses could be making more money, it only leads to disaster. I think most times that we go through an inflationary period and central banks don't react appropriately and let it run hot, we go to a recession. So as much as high interest rates right now sound like the worst thing, because things are going to be more expensive to finance, in the long term, it prevents us from going into a type of recession or a type of stagflation moment. So don't be surprised if we continue to see this movement out of the ECB. You're probably going to see them talk down any comment of raising interest rates. However, I think by halfway through the year, despite what's happening in Ukraine and Russia, we're going to see them start to raise interest rates. If the war does end earlier, then I think they're going to do it a lot faster. If it does persist, they're going to possibly turn a blind eye to it. Now over to the Fed. So we saw Jerome Powell speak on Monday and a few other Fed speakers. What's really interesting at the moment is we basically have a interest rate hike planned for every meeting this year. The most aggressive thing that they said this week, though, is we could see a 50 basis point hike in May and another 50 basis point hike in July. So that's 1% over the next 2 meetings. That brings them up over 1% in terms of interest rates. And if they're going to continue on their path, interest rates by the end of the year in the US could go all the way up to 2%. Why are they so aggressive? Going back to what we spoke about earlier, it's because of inflation. A central bank's biggest fear is for an economy to be overinflated, out of control, and too hot. So you could see on the right, the projections, we're going to see in the long run, interest rates higher than what we expect at the moment. The whole idea is to get inflation back down to a controlled level below 3%. Sorry, guys. So if you have a look at this dot plot, this is basically every Fed member and where they see interest rates coming over the next few years. And you can see in the longer run, or in 2023 to 2024, they want interest rates to be around 3%. And once they've hit their target, or once they've done the job of reducing inflation, we're going to see interest rates fall back down post 2024. So the Fed's view is that inflation can be controlled in the next 2 to 3 years. However, if history tells us anything, it takes a little bit longer than that before we see a change in hiking policy. So a Fed hike every meeting this year, yes, I know it's quite aggressive. Have we seen it before? No. Is it the right thing? Possibly. Every rate cycle that the Fed has done in history, so there's been 16 rate cycles over the last, 150 years. 13 of the last 16 rate hikes have resulted into a recession. The difference about what they're doing now is they're going as aggressive as they can. What the goal is, if they go aggressively, they could front run what the market does. They could front run over inflationary measures. So it could be the right thing. As much as this next 12 months could hurt. If, let's say, the Fed start raising rates, or do raise rates every meeting this year, and the RBA doesn't, then that's really going to hurt the Aussie. But we just have to see what the RBA does and have to wear it. Unfortunately, the Federal Reserve has a bigger issue of inflation than the RBA does, which we'll talk about next. So if you have a look here, on the right-hand side shows you what the forecasts are for interest rates in Australia. And as you can see, as much as we expect the meeting, or there's possibility of a rate hike in the June meeting, it's still not 100% priced in. The governor keeps saying it's plausible for a rate hike to happen this year. However, they haven't actually specified that it will happen. The biggest concern from the RBA is if unemployment and wage growth is at a sustainable level, right? However, this week's announcement from the Federal Reserve has put a lot of pressure on the RBA to do that, to start raising rates, to start controlling inflation. But we really haven't seen it yet. So I think what you guys are going to see from the central bank over the next month or so is our next CPI reading is next month. That's going to show Q1's inflation levels. If we see inflation levels above the target of 3%, then you might see that 92% level on the right-hand side. You might see that go above 100% because, conditions have been met for a rate hike in Australia. Despite rate hikes still not being certain in Australia, unfortunately, most home loans, most business loans, any business with debt will start seeing increases in their interest rates, or should have already started seeing increases in interest rates, purely because a lot of banks or a lot of financial institutions have debt in US dollars. And then right now, the increase in interest rates there will start feeding down into Australia. You don't have to wait for the RBA to raise rates for that to happen to us. And that is it, guys. I tried to keep it as short as possible. If you guys have questions, there's a Q&A box on the top right-hand side. I'm happy to wait for them before I sign off. If not, we'll send an email to everyone with our details that you can drop by to us. I know it's going to be a really interesting time. It's not really a traditional time in markets at the moment. With what's happening in the Ukraine and Russia, and what's happening from central banks, it's going to be an interesting year. Okay, I got one question. The only question I always get in webinars is where I see the Australian dollar going this year. Aussie US at the moment, like I said, is around 74 cents. I see top side at 75 at the max. Why I say top side at 75 cents is I feel like the Australian dollar is a little bit overbought. A lot of the movements that we saw over the last 4 weeks was, your big hedge funds taking the wrong bet. A lot of big financial institutions had a bet that the Aussie dollar was going to fall. We spoke about risk off moves and the Australian dollar falling. Unfortunately, last 4 weeks they didn't. They got squeezed out of those positions, so they had to cancel those positions, right? I feel like any negative news that comes out of Russia again, or if the West and NATO get involved, could see the Australian dollar fall. So topside 75, I think we'll float around here because we won't see any news from Russia and Ukraine in the short term. And let's see if there's any more questions. No, I think that's it. So thank you guys for attending. We'll send details out after this if you have any questions, and have a good afternoon. Thank you.